Hello, this is Travis Taylor presenting my final project for intermediate accounting. I chose to do my project on the Danaher Corporation. Danaher designs, manufactures, and markets professional, medical, industrial, and commercial products and services across four primary business segments. They are life sciences, diagnostics, dental, and environmental and applied sciences. They're an S&P 500 component with approximately 63,000 employees. I chose this company because I work for a subsidiary of the company of Danaher. And Danaher itself is primarily a holding company made up of several hundred operating companies, each one reporting up through a different business segment. So starting out here, we have the financial statements. In terms of assets, approximately $45.3 billion worth of assets, net assets in 2016, made up of basically 23 billion in stockholders' equity. In terms of the income statement, kind of net earnings in 2016 were 2.55 billion, with earnings per share of the average, basically a net earnings per share of 3.69, and a diluted earnings per share of 3.65. And there was a net increase in cash of 172.9 million throughout the year. So one example of the time value of money concepts that are used in the book that were also found in the financial statements and could be important to the company in the future are pension and other post-retirement benefits. Now the company has obligations for various pension funds, and to determine the amount that they should contribute each year in order to attain the desired future value, they use the time value of money calculations as described in the book. Now, in order to make those calculations, they make some assumptions in terms of the discount rates and the expected rates of return over time. Now, the reason this is important is because if those assumptions turn out to be wrong, and then the pension fund is either over or underfunded. Now, in a situation where it's underfunded, the company still needs to make contributions to adjust the plan so that they have the amount of money needed to make the pension payments and meet their obligations. Now, according to the 10K, if the actual results vary significantly from the assumptions, the company's financial statements could be materially affected. Now, in terms of cash and receivables, the company increased its cash and cash equivalents by $172.9 million for the year. The main reason for the increase was the decrease in the amount of cash used in financing activities. Now, in previous years, there were significant cash outlays for kind of financing and acquisition, primarily the acquisition of businesses. That acquisition activity was reduced this year. It was 14,248 million, or 14.2 billion in 2015, and only 4.8 billion in 2016. Still a significant amount of money, but makes a big difference in terms of the cash on hand. In terms of the receivables, the company uses the allowance method for determining the allowance method for doubtful accounts. This was listed as the best practice in the book as well. One issue that I did notice in terms of the accounts receivable was I calculated the accounts receivable turnover of 1.08, which is an average of 338.5 days to collect receivables. Now, this seems like a really long time. The rule of thumb that was listed in the book said that the average day should approximate the payment terms offered to customers, and it seems unlikely that the payment terms are 338 days. So I think this is something that could be addressed. Now, the company primarily uses FIFO for its inventory valuation, with some exceptions that use last in, first out instead of the FIFO. They did report in their FIFO that there was an immaterial amount of LIFO liquidation, which is good. However, one potential inventory issue that was listed in the management discussion and analysis section was that a significant portion of their sales are through international distributors and dealers, and not directly to the end user customers. One of the challenges they reported was that the demand coming from these distributors and resellers is sometimes unpredictable, and that's a risk factor. Basically, if the demand from that channel is much higher than expected, then there could be a significant amount of LIFO liquidation because it would be selling the older layers of inventory in order to meet unexpected demand. Now, a possible solution for this, to the extent possible, try to work with that dealer network to better predict demand, or somehow enter into contractual terms with when they bring on new dealers that they kind of stabilize some of that demand. In terms of the additional inventory valuation issues, the company report uses the lower of cost or market for their inventory valuation. They had to write down $85 million worth of inventory in 2016. This seemed to be primarily due to acquisitions. They basically acquired inventory that then did not have the value that was stated. And no specific information is given on the financial statements and how the lower of cost of market is applied, whether or not that's in the individual items or across major categories or of total inventory. But overall, the amount of the inventory written down through the course of the year does not seem to be material.